Hey guys, welcome back to Finance with Azhar, where we simplify money, investing, and financial freedom. Today's video is actually very special because we're going to answer one of the most popular questions that we get, and that is how to start investing with just $100. So, in this video, I'm going to show you exactly what you can do with $100 to kickstart your journey towards financial freedom. Alright, so if you are ready to take control of your money, then you are in the right place. Before we dive in, just want to ask you to please support us by hitting that like button and subscribing to our channel if you want to be part of our awesome community of learners and investors. Just hit that subscribe button. We post new videos every single week, demystifying money and investing. Alright, let's jump into the video. Point number 1 is actually a mindset shift that you need to have when it comes to investing, and that is, you do not need thousands of dollars to start. Even $100 is more than enough to begin, so all you have to do is invest that $100 wisely, and then continue to add to it. And the earlier you start, the better off you'll be in the long run. The second point is set clear goals. You have to ask yourself, why am I investing, and for what? Is it to grow my money quickly for an upcoming purchase, something like a car or a house? Is it for retirement, or is it for financial freedom to live life on your own terms? Because based on your goal, the way you invest, and the amount of risk that you're willing to take is going to be different. Thirdly, before you start investing, make sure you have an emergency fund in place. An emergency fund is basically a small safety cushion that you keep aside for unexpected expenses. So, having a buffer between 3 to 6 months of your living expenses is generally recommended. But if you're just starting out and you don't have any savings at all, then start with whatever you have. So, even if you only have $20, keep that aside and use the rest to invest. And once you build up your emergency fund, then you can consider investing. That's when you can move on to investing. Next point is low-cost brokerage apps. One of the best things about investing nowadays is that thanks to technology, it's easier and cheaper than ever before to start. You can now open an account with a low-cost brokerage app and trade stocks, ETFs, and mutual funds for free. Some popular ones include Moomoo, Public, Webull, Robinhood, and Moomoo. Now, I personally use Public. I've been with them for over 2 years, and I've had no issues whatsoever. They have a great app interface, a variety of investment options, and 0 commissions on trades. So, do check out these platforms and see which one works best for you. Fifthly, we have index funds and ETFs. These are actually the best investment options for beginners because they offer instant diversification with just one investment. For example, when you buy a VTI ETF, you're actually investing in more than 4,000 US companies. So there's a lot of benefits that come with investing in index funds. First and foremost, diversification, which helps you manage risk. Secondly, low fees. ETFs usually have a very low expense ratio, meaning that you won't have to pay a lot in fees to own and maintain your investments. This will help you keep more of your hard-earned money. Thirdly, liquidity. ETFs are traded on stock markets, which means you can buy and sell them easily and quickly if needed. Fourthly, professional management. Since index funds and ETFs are managed by experienced professionals who know the market inside out, they're able to make informed decisions about which stocks to include in the portfolio and how to balance the risk versus reward. Lastly, performance. Over the long term, index funds have proven to generate higher returns than most actively managed funds. By investing in an index fund, you're essentially betting on the entire market, which historically has always gone up. Now, I will leave links to some of my favorite ETFs down below. Moving on, we have fractional shares. So, One of the biggest perks of investing nowadays is the ability to buy fractional shares of big companies. This means that you don't have to have thousands of dollars to invest in a company like Apple or Amazon. You can own a piece of these big companies with just a few dollars. This allows more people to invest in high-priced stocks without having to save up a huge amount of money. All you have to do is find a brokerage platform that supports fractional shares. Choose the stock you want to invest in, and then decide how much of that share you want to buy. Next point is high-interest savings or robo-advisors. These are two easy options that you can go with if you want to avoid the stock market altogether, or you're too intimidated to invest in individual stocks. A high-interest savings account allows you to earn interest on your deposits. Although the rates are not super high, it's still a great option if you're looking for a risk-free way to grow your money. As for robo-advisors, these are online platforms that use algorithms to automatically invest your money for you. So, you'll answer a few questions about your financial situation and risk tolerance, and the platform will automatically invest your money according to your needs. Both options are relatively simple and straightforward and require little to no maintenance. Next point is dollar cost averaging. So, instead of putting all your $100 into one investment, consider dividing it into smaller chunks and invest that chunk every week or every month. This practice is known as dollar cost averaging. It's a great way to reduce the risk of investing in the stock market because you're not putting all your eggs in one basket at once. When you invest in this manner, you're taking advantage of the benefits of compounding interest and reducing the impact of market volatility. So, let's say you have $100. Instead of investing it all at once, you can break it down into $20 chunks and invest it every week. This way, you're able to buy more shares when the stock price is low and fewer shares when the stock price is high. Overall, this helps to reduce the average cost per share and mitigate the risks associated with investing in the stock market. Another benefit of dollar cost averaging is that it can help you build discipline. By setting a regular schedule for your investments, you're more likely to stick to your investment plan and avoid making impulsive decisions. Another thing to note is that when you invest in this manner, you're also taking advantage of the power of compounding interest. When you invest money, it earns interest, which is added to your initial investment, and then that amount earns interest, and so on. Over time, this can have a significant impact on your overall investment returns. By sticking to a consistent investment schedule, you're able to take advantage of this powerful tool and watch your investments grow over time. Moving on to the next point, avoid high-risk bets. This is crucial, especially if you're a beginner investor. When you're just starting out, it's important to focus on building a solid foundation for your investment portfolio. That means avoiding risky investments that could potentially wipe out your entire investment. Penny stocks are often highly volatile and illiquid, which means that it can be difficult to buy and sell them. Additionally, many penny stocks are associated with companies that are not financially sound or have poor management. Investing in such companies carries a high risk of losing your entire investment. Similarly, get-rich-quick schemes are often scams or pyramid schemes that promise unrealistic returns. They prey on people's desire to make money quickly and easily, and often result in investors losing their hard-earned money. Lastly, risky cryptocurrencies. While cryptocurrencies have the potential to generate high returns, they are also highly volatile and risky. Many new investors get drawn to the hype surrounding cryptocurrencies, but it's important to remember that not all investments are suitable for everyone. By avoiding high-risk bets, you can protect your investment and ensure that you are building a strong foundation for your financial future. Lastly, focus on consistency. The true power of investing lies in consistency. It's not about the amount you invest once. It's about the habit of investing consistently over time. So, even if you can only invest $100 initially, that's fine. What matters most is that you stay committed to your investment plan and keep adding to your investments regularly. Remember that investing is a long-term game and consistency is key to success. We hope you enjoyed this video and learned something valuable. If you found it helpful, don't forget to hit the like button and share it with a friend. Thanks for watching Finance with Azhar. Until next time, keep growing, keep investing, and stay financially free.